Hello everyone, welcome to the Bowtie Breakdown. I'm Garry Morin The BowTieGuy, and this morning I am at Sierra Pacific Mortgage in North Providence with my friend Peter Nastasi.
Morning, Garry.
Good morning, Pete. Thanks for letting us stop by. Today, Peter is going to fill us in on some information that is taken into consideration when you are applying for a loan. So Pete, let's talk about debt to income ratio. What is it and what does it mean?
Sure, absolutely. There's basically three things that we look at from a lending standpoint, right? We're looking at a borrower's income, we're looking at their credit, and we're going to look at the collateral. So
okay.
The property that they're looking to purchase. So debt to income is going to fall under the income category.
Okay.
So just to kind of simplify debt to income ratio.
Yeah, we like simple. We don't want to get very complicated.
Yes. Just to use some rudimentary numbers. Let's say a client makes $3,000 a month in gross income, and their expenses are, including the home that they want to buy, are at $1,500. Okay, they're at a 50% debt to income ratio.
Okay. So
debt to income ratio from program to program can vary greatly. So for instance, with a conventional loan, you really can somewhere between 45, maybe up to 50, depending on the borrower.
Yep.
If the borrower has some reserves after the transaction, if they have a high credit score, you may be able to push the limit, get it up to a 50% debt ratio. Whereas with an FHA loan, really the limit is per the system. What that means is when we run it through the automated system, FHA will let us know, okay, you're at a 55, a 56, and that's usually around the limit that people hit. And it gives you a little bit more flexibility, so you can kind of maybe push it a little bit if the borrower is comfortable with the payment, right? Yep. Because that's the biggest thing.
Yes.
Right? So here, we don't want to sit down and pre-qualify a borrower and let them know, you are pre-approved up to $400,000.
Yep.
And then they go out shopping with you, Garry, and you go into contract and they realize their mortgage payment's $3,500.
I can't afford that.
Yes, they can't afford it, right? So we will do a combination when we're doing a pre-qual. So we will let them know what their debt ratio is, we'll let them know what they qualify for, and most importantly, we will let them know what the payment is on something like that.
Which is huge because not a lot of lenders do that, and we run into that same scenario. They want to put an offer in, but they have no idea what the monthly payment is.
Correct.
So I try to stress that as soon as I meet up with them. They say, I'm approved for $500,000, here's my pre-approval. Okay, but do you know what your monthly payment is going to be? And where are you comfortable with that? And usually I get the answer, no. How do I find that out? And I usually bounce it back to you guys.
Yes, absolutely. So we will sit down and we will let them know, hey, you're pre-approved up to this is your payment, but what is your comfort range?
Yep.
Where do you want to be? If you say, I want to be no more than $3,000 a month, then that's where I'll say, okay, you need to look in this price point.
This is the range
and then this is what you need to show them. Correct. Okay. And then it's up to them. Just because their debt ratio allows them to go a little higher, it doesn't mean that they're comfortable with that.
Right. Ultimately, people want to be comfortable in their house and not just be house broke.
As they should. As they should, because taxes will increase, insurance will increase, so the payment unfortunately will go up, even though their payment is fixed potentially.
Or you have that issue with the escrow where they don't draw enough and then they
you have a shortage.
That was the Bowtie Breakdown. I'm Garry Morin. Thanks for watching. See you next time.